I don't know if there's an expectation it wasn't coming, but I think that the key is that the markets have been powered really by the fundamentals. And the fundamentals, certainly in the U.S., have been incredibly strong. We just saw 25% second quarter earnings growth, driven by strong top line growth. So I think people have been focused more on the immediate fundamentals, which have been incredibly powerful. But now we'll see what happens as if the trade tariffs are actually announced.
But the question is, if they are, what happens?
Well, it matters. I mean, number one, it'll definitely have some impact on China's growth. That's important because that will influence emerging market growth and ultimately growth in Europe. And for us here in the United States, it will have an impact on inflation. Depending on how big the impact is, that could drive rates somewhat higher. And if rates go higher, the dollar goes higher, and then ultimately feed into growth here in the U.S.
Krishna, how do you handicap it, though?
Well, so I think it's quite likely that they do something. Whether that is sustainable in the long run, I think is debatable. From an economic policy standpoint, tariffs are never good. If the intent is to reduce trade deficit, reducing fiscal deficit is probably the best thing you can do, because then you don't have to import savings, which is what trade is. Having said that, I think Keith is absolutely right. If this is taking place at a time when the economic growth in the U.S. is reasonably good, I think that kind of cushions the market. If it was a different situation, I think the impact would have been significantly worse. But say whatever you want. At the end of the day, it is market negative.
How do you think the Fed is going to think about the China piece of all of this come this fall?
Well, look, they'll look at the whole picture.
But do you think that's going to factor in a big way?
It'll factor in if, in fact, the fundamentals begin to get impacted, meaning inflation gets impacted and growth gets impacted. And then they'll also have a lens on the global aspects of that. So it will all feed in, I think, to their decision making, although we still anticipate there'll be further hikes, certainly one in September. And right now, the odds that favor, we think, another one in December.
But broadly speaking, you think the market is where at the end of the year?
We're staying with a 3,000 price target for the S&P, which would be about 3% plus up from current levels.
You're more or less aggressive?
No, I think that's probably the right range. Markets are probably going to go higher. I think we will find a resolution to this in some form. It'll just cause a lot of heartache getting there, right? I think it's more that than anything else. I think the underlying economic momentum is strong enough for the Fed to tighten at least 2 times. If there is any negative impact, it impacts what they do in 2019 far more than 2018.
What are the implications of to the extent these tariffs take place on some of the other places you'd like to invest in terms of because they could actually be beneficiaries of this?
Well, they could, but at the end of the day, the tariffs in and of themselves are emerging market negative. Just from a sentiment standpoint, from a flow standpoint, from the dollar strength standpoint, it acts against emerging markets. So for emerging markets to do well, we would rather resolve this issue rather than prolong this issue.
Krishna, there's a school of thought that, look, this is a trade war that is going to hurt the Chinese much more than us, that they would therefore blink first. We have seen it play out in their markets quite a bit more ferociously. Here, markets don't seem to care.
Well, I think it's because the underlying growth in the U.S. is as turbocharged as it is because of tax cuts. If that wasn't the case, I think we'd probably be debating the issue that you're raising. For now, the Chinese probably get impacted because the impact of it on their growth is going to be meaningfully higher than what it is here. From a long-term perspective, I think it's far more inflationary in the U.S., which brings the Fed into the play and increases our risk meaningfully.
Here's what I don't understand, though. If it's going to be very bad for the Chinese, that suggests that people would stop buying some of these goods. Right? That's why it's bad for the Chinese, because if the tariffs go up, we're not going to be buying the goods that are made there.
It's about elasticity. That is, they'll buy the goods, perhaps not as much, and therefore growth in China will slow down.
Different question. Is there any place outside of the United States you put money right now? Well, meaningfully? That you think is going to be like the great upside surprise of all of this?
Well, look, we still believe you want to be in the U.S. We're overweight the U.S. We like large and small. We still have an exposure to international
large
developed.
And small. By the way, in the U.S., large and small across the board. What about tech?
We still like tech. You know, the sectors we favor include tech. But outside the U.S., we're neutral on developed international right now. There's obvious problems in Europe. And emerging markets, we've been wrong on this, but we've been slightly overweight by about 1%. we're hanging in there because we think you could see a possible pop near the end of the year, but we're keeping a close eye on EM.
I think from a valuations standpoint, and if you have a long enough perspective, emerging markets are ridiculously cheap at this point.
Right.
So if I had $2 to put to work and I had a 5-year perspective, I would be buying emerging markets far more than
emerging markets broadly or a specific market?
Well, emerging markets in Asia, where the risk premium has gone up and fundamentals really haven't deteriorated much.